Hi everyone, welcome to this channel. I am Michelle, and thanks for joining me here. In the next couple of minutes, we'll break down exactly how to audit a blockchain, whether it's a public ledger, a DeFi protocol, or an enterprise private chain. By the end of this video, you'll understand the core differences between traditional financial audits and blockchain audits, the key risk areas, and the step-by-step methodology used by top auditors today. Before I begin, please feel free to subscribe to this channel and watch this e-learning video and the rest of the videos in this channel until the end. This is imperative as this would give us good supports to create more e-learning videos going forward. Let's start with a truth. Blockchain is not unauditable, it's just unfamiliar. Traditional audits rely on sampling, reconciliations, and internal control testing. Blockchain replaces trusted third parties with cryptographic verification and consensus. So as auditors, we adapt. We trade bank statements for block explorers, and we trade management assertions for smart contract code. Our goal today, 3 things. 1. Understand the unique risks of blockchain. 2. Walk through a live audit procedure from planning to reporting. 3. Give you actionable tools and checks. First, what are we auditing? A blockchain is an immutable, append-only ledger. Transactions are grouped into blocks, cryptographically linked. No single entity controls the data, but that doesn't mean it's error-free. 3 major risk areas make blockchain audits unique. Risk 1, smart contract vulnerabilities, code that holds millions in value. A single bug, re-entrancy, integer overflow, access control flaw can drain funds instantly. Unlike traditional systems, you cannot just reverse a blockchain transaction. Immutability works against you here. Risk 2, private key management. In traditional finance, a CFO signs off. On blockchain, whoever holds the private key controls the assets. If keys are lost, stolen, or shared improperly, no bank steps in. Auditors must verify key governance, who has access, how keys are stored, and whether multi-signature controls exist. Risk 3, oracles and external data. Many blockchains pull data from outside, prices from exchanges, weather data, election results. If that oracle is compromised, the smart contract makes wrong decisions. The audit scope must include those external data sources. So a blockchain audit is not just checking math, it's checking code, keys, data feeds, and consensus rules. Now, how do we actually do it? Every audit starts with planning. For blockchain, step 1 is defining the subject matter. Are you auditing a cryptocurrency balance sheet, a smart contract before deployment, or a full protocol's transaction history? Phase 1, understanding the blockchain type, public permissionless like Ethereum, public permissioned like XRP Ledger, or private like Hyperledger. Each has different access levels. For public chains, all data is visible but anonymous. For private, you may need node access. Phase 2, risk assessment. Use a blockchain-specific risk matrix, high risk, custom token logic, admin keys with unlimited minting power, upgradable proxies without time locks. Low risk, simple value transfer with no smart contracts. Phase 3, materiality. In crypto, materiality might be based on market value of assets at risk. For a $100 million DeFi protocol, a $500,000 bug is material. For a small NFT project, maybe $10,000. Now, tools. You will need a blockchain explorer like Etherscan or Solscan, a node client for direct RPC calls, and static analysis tools like Slither, Mithril, or Securify for smart contracts. For transaction tracing, use tools like GraphQL or custom scripts with web3.py, and most importantly, the audit checklist. Let me give you the top 5 items right now. Here is the heart of the presentation, the step-by-step blockchain audit in 5 procedures. Procedure 1, transaction integrity testing. You take a sample of blocks, say 1 in every 1,000 blocks, and recalculate the Merkle root hash. Compare it to the block header. This verifies that no transaction has been altered after the fact. On public chains, this is usually done by full nodes, but as an auditor, you independently validate a subset. Procedure 2. Wallet and balance confirmation. Obtain a list of addresses under the entity's control. For each address, query the blockchain at block height X and at block height Y. Confirm that the reported balance and all incoming/outgoing transactions match the entity's records. This is the blockchain equivalent of a bank confirmation letter, but it's public, time-stamped, and non-repudiable. Procedure 3. Smart contract logic review. This is the most technical part. You obtain the deployed contract bytecode, decompile it, and compare it to the source code the team claims to have used. Then run static analysis for known vulnerabilities, re-entrancy, front-running, timestamp dependence, and gas limitations. Then dynamic analysis. Deploy the contract on a testnet and run attack scenarios. Procedure 4. Governance and key controls. Interview the team. Who holds admin keys? Is there a multi-signature wallet requiring 3 of 5 signatures? Review key generation logs, hardware security module usage, and key rotation policies. Test the multisig by initiating a dummy transaction. Does it require the expected number of approvals? Procedure 5. Oracle and dependency review. Identify all external data sources the contract calls. For a price oracle like Chainlink, verify the heartbeat. How often is the price updated? Check historical deviations. Did the oracle ever return 0 or an outdated price? For cross-chain bridges, test the relayer mechanism. These 5 procedures form the backbone of any thorough blockchain audit. Now, let's talk about what you actually deliver. Your audit report is different from a traditional one. It must include 1. Scope definition clearly, block range, contract addresses, and network, mainnet versus testnet. 2. Methodology with specific tool versions and test cases. 3. Findings categorized by severity, critical, high, medium, low, informational. 4. Remediation guidance for each finding. And 5. A disclaimer that the audit is point in time. Smart contracts can be upgraded or changed. Now, common pitfalls, avoid these. Pitfall 1. Auditing only the source code, not the deployed bytecode. The compiled code can differ due to compiler versions or optimizations. Always verify on-chain bytecode. Pitfall 2. Ignoring administrative backdoors. A contract might look safe, but if a single address can pause trading, change fees, or mint new tokens, that's a central point of failure. Pitfall 3. Forgetting about gas economics. A transaction that fails due to out of gas can still cost fees. Audit for gas griefing attacks. Pitfall 4. Assuming all block explorers are accurate. Some explorers index data incorrectly. When in doubt, query a full node directly. And a special note for stablecoins and wrapped assets. Confirm that off-chain reserves match on-chain supply. That requires a combined audit, proof of reserves from a custodian plus blockchain data. Let's walk through a mini example. Suppose you are auditing a simple token vesting contract. The client says, this contract locks team tokens for 1 year, then releases 10% per month. Your steps. 1. Fetch the deployed contract on Etherscan. Verify the bytecode matches their GitHub source. 2. Run Slither. It finds a potential re-entrancy in the withdraw function. Note, the contract uses transfer, not call, so safe. 3. Check admin keys. The contract has an owner address. That address is a multi-sig wallet. Good. 4. Test edge cases. What happens if someone calls release before the lock period? The function should revert. You write a quick test in Hardhat, it reverts. Good. 5. Simulate the full schedule. On a testnet, set the block timestamp to day 365, call release, gets 10%. Day 366, another 10%. But wait, The formula uses integer division. 100 tokens divided by 10 months equals 10 tokens per month. Fine. But what about remainder? The contract leaves dust. That's a low-severity informational finding. 6. Write the report. High severity, none. Medium, none. Low. Rounding dust remains in contract. Recommendation: send dust to a burn address or distribute proportionally. That's a complete small audit. Scale this to thousands of lines of code, and you have a professional engagement. To close, blockchain auditing is not magic. It combines traditional audit discipline with new technical skills. Your 3 key takeaways. 1. Always verify on-chain data. Never trust a client's API alone. 2. Smart contract logic and private key governance are the highest risk areas. Test them destructively. 3. Your report must be transparent about limitations. No audit guarantees 100% security, but it does reduce risk dramatically. If you are new to this space, start by auditing small testnet contracts. Use free tools like Slither and Echidna. Read audit reports from firms like Trail of Bits or Consensus Diligence. And remember, in blockchain, trust is replaced by verification. That is exactly what auditors do best. This concludes my sharing today. If you found this e-learning video is useful, please feel free to subscribe and share it out with your friends and colleagues. Thank you and have a nice day. Hi everyone.